There is cash, and then there is cash. Whether it's physical cash or CDs or treasuries or other cash equivalent, there is a reason to include it in your investment mix. Foster and Motley's Tom Guidi is with me, Patrice Sikora, to talk about cash. Tom, thanks for being here. And let's start off by talking about why we're talking about this cash.
Sure. Thanks for having me, Patrice. Always appreciate seeing you. So cash is an important part of everyone's investment mix, but there's facets to it, and it's often misunderstood. Some people will hold cash as a investment, and some people holding cash earning some interest, and some people will hold cash uh, the bare minimum just to get by with day-to-day expenses. There's probably a good place in between those two, and that's why we're here today.
All right, well, let's go through some of the reasons to have cash.
Yeah, and sometimes this is underdone by a lot of people, but sometimes it's overdone. The reason to hold cash is really for your expenses. So we want the cash to be there to spend. So it's spending on things that are planned or even things that are unplanned. So unplanned would be an emergency fund. And a lot of people suggest holding 3 to 6 months cash set aside in a savings account or similar vehicle for emergencies. And this could be anything from an unexpected home repair, a period of unemployment. Things happen. And the amount of cash you should hold, really varies a bit on how likely are some of those things to happen, um, and the size of your ongoing expenses. Some things are more planned. So if you're in the process of shopping for a car, you don't intend to finance it, it's fine holding that money set aside in something that's earning a little bit of interest while you shop for a car or a house or other large planned purchases. The other thing that comes up, if you had a big earning year last year and you're just waiting to pay your tax bill, but you don't want to give the government money until the last possible moment, yeah, keep that set aside in something earning some interest, but make sure it's set aside. So taxes can be another reason. And there could be a whole host of other reasons, but they all fit with that theme. They're either planning for the unplanned or planning for expenses that you know are coming up.
Are there any reasons not to hold cash?
Yeah, everybody needs some level of cash, but some people overdo it. So cash can be part of a strategic investment plan, but holding too much is likely not going to provide you with the returns that you need to meet your long-term objectives. So you think about the interest that you earn on cash, and right now it's actually pretty good. It's been better than we've had for a few years, but over the long run, it's not likely to do much more than keep up with inflation or even that. So the longer you hold the cash, really the lower its value is for you to spend that money. Um, a lot of people, maybe after a turbulent market, stock market, bond market, they might be inclined to hold more cash, but really you have to have the discipline to understand that yes, cash is good at the right amount, but for longer term investments, it really belongs in things like stocks or bonds or other investments that are going to meet your long-term objectives.
What should you consider when you're trying to make up your mind? Should I put this aside or should I invest this?
Yeah, good question. So, first off, it's how much cash or what are the known things? So, what are my near-term expenses? They're going to come up. What are uh, my ongoing living expenses? And then plan for somewhere, whatever feels comfortable, 3 to 6 months living expenses set aside for the emergency, for the unknown. Now, when you're considering how to invest that cash, which is kind of the next step, uh, really you have to think about, okay, how much of it do I need potentially the next day? Or maybe there's things that it's a known expense, but it might be 3 months down the road or 6 months down the road, some time period. So that's termed, we call that liquidity needs. So how much of the cash needs to be liquid to be available if you need it the next day? If it doesn't need to be liquid, then it opens up the possibility, not the requirement, but the possibility that something like a CD or a treasury could work because that has a maturity when you get the money back from that investment. But things that are more of the unknown, could pop up any moment, those are the things that you need to have more liquid. Things like a bank account, savings account, a money market account. Those things are available any day that you need them. Interest rates are an important factor on any investment, and cash is included. The interest rate on cash for the different vehicles can vary. So savings accounts right now generally pay the least, though some banks are saving some money by having online only bank account experience. By not having those physical branches, they pay a bit higher of an interest rate. What's usually a little bit higher than even the online banks right now would be things like a money market account. Money market account, some of them you can buy through a bank, but usually the higher paying money markets you can buy through an investment company, a brokerage like Charles Schwab or Fidelity or Vanguard. They offer money markets that are invested, underlying this, it's invested in short-term US treasuries, but they just pay that treasury interest without varying the value on a day-to-day basis. And at the end of every month, they pay you interest for the average balance during the month. A lot like the bank account. Now, the bank account has FDIC insurance. The money market invest in treasuries and things that are other short-term interest-bearing investments that are high quality, but it's not FDIC insured. Now, 99% of the time plus, there's never any problem, but it has historically happened that they call it breaking the buck, where the money market's lost value for a short period of time. So that's another possibility. If you have an expense coming down the road, but you still want to set some cash set aside for it, let's say, it's that tax question that we brought up earlier. Let's say you don't have to pay these taxes for 9 months. You could go out and buy a CD and maybe get a little bit higher rate and, importantly, lock in your interest rate by investing in that in a CD as long as it comes due before you need to actually use the money. If it's a really large expense, maybe even a US Treasury could fill the same role if it offers even a better rate.
All right. Well, where could you go, do you think, considering your cash holdings and locations, is your advisor the best place to go to find out the options?
Yeah, I think if you work with an advisor like Foster Motley, talking to your advisor first makes sense. We find sometimes in the past there's been clients who had some extra cash set aside. They put it in a CD and it's locked in for a period of time unless they want to give up the interest they earn, but maybe that wasn't the optimal thing to do. Or they put some money in a savings account and the savings account was earning half the level of interest as a money market. So sometimes an advisor is just going to be better prepared for comparing the different options and considerations that you might have.
All right, then. And how could people be reaching you folks at Foster and Motley?
Yeah, Foster Motley, we can be reached by speaking to your advisor here if you're one of our current clients. Our website is www.fosterandmotley, all spelled out, .com. Or you can give us a call. It's area code 513-561-6640.
Tom, thanks so much for all that information. And if you have questions about cash and how you might be able to put yours to work for you, check with Tom and the folks at Foster and Motley. Be sure, of course, to subscribe to this podcast so you know when a new episode is ready for you and share it with others. I'm Patrice Sikora, and thanks for being with us.